If you own a rental property in Australia, the tax office has a number that should worry you. When the ATO ran a random audit of individual returns reporting rental income, 9 out of 10 of them contained errors. That's not a few careless landlords, that's almost everyone. And the most common mistake is overclaiming deductions you are never entitled to. This isn't a small leak. The ATO estimates incorrect rental deductions alone cost the budget around $1.5 billion in lost revenue every single year, and it's now aggressively clawing that money back. There are 3 mistakes behind most of it: overclaiming for private use, mislabeling renovations as repairs, and deducting travel that's been banned for years. Here's the headline figure. In the ATO's random inquiry program for 2020 to 2021, 90% of returns reporting rental income required adjustment. But here's the part nobody tells you. The ATO now data matches against your bank, your Airbnb-style platforms, and land titles. So the days of hoping nobody checks are over. 3 moves today. Audit your rental calendar and apportion expenses correctly. Separate genuine repairs from capital improvements. And strip out the travel claims the law no longer allows. The first trap is claiming full-year deductions when the property isn't genuinely available for rent. The ATO's 2025 Rental Properties Guide is blunt. You must apportion expenses to reflect only the period the property was genuinely available at market rates and only the portion used to produce income. If you holiday there yourself or let family stay free or at mates' rates, those weeks cannot generate deductions. Let's make it concrete. Say your property costs $35,000 a year in interest, rates, insurance and management, and you rent it at market rates for 30 of 52 weeks, using it yourself the rest. Under the ATO's 2025 guide, only about 58%, $20,300, is deductible. Claim the full $35,000 and you've overclaimed $14,700 in a single year. The second trap is misclassifying repairs versus improvements and claiming items that simply aren't deductible. The ATO draws a hard line. A repair restores the property to its original condition and you can deduct it now. But a full kitchen or bathroom upgrade is an improvement, and that's capital works, written off at just 2.5% a year over 40 years under Division 43, according to the ATO's 2025 guide. And it stacks up fast. Picture a landlord who spends $40,000 on a kitchen and bathroom upgrade and $2,000 on interstate inspection travel, then claims all $42,000 in year 1. The ATO says the travel is completely non-deductible, and the upgrade gives just $1,000 a year at 2.5%. That's a year 1 overclaim of $41,000, roughly $16,000 in back tax at a 39% rate. Here's a belief that traps thousands of landlords. Many think they can claim trips to inspect their rental, and it used to be true, so they keep doing it. The fact is, since the 1st of July 2017, individuals cannot claim any travel for a residential rental property. Every flight and night of accommodation you've deducted gets clawed straight back. Put the 2 costs side by side. The private use mistake overclaims around $14,700 a year using the ATO's apportionment rules. The renovation and travel mistake overclaims up to $41,000 in a single year. But here's the part nobody tells you. Both get back taxed at your marginal rate, plus shortfall interest the ATO charges at around 8 to 10% a year. Let me show you how this plays out for a real person. Meet Sarah. She's 42. A marketing manager on a $130,000 salary, which puts her in the 37% bracket plus 2% Medicare. She owns a coastal holiday unit worth around $850,000 with a $650,000 loan costing about $39,000 in interest a year. She's done her own return through MyGov for 7 years. Discovery One cost her $17,500 a year. Sarah uses the unit herself and for family roughly 8 weeks a year, so it's only genuinely available for about 34 of 52 weeks. That's 65% deductible under the ATO's 2025 rules. On $50,000 of annual expenses, the correct claim is $32,500, not the full $50,000. Over 4 years, that's $27,300 in underpaid tax. Discovery 2 was bigger. 2 years ago, Sarah replaced the original 1980s kitchen and bathroom with a modern fit-out for $55,000 and claimed the whole lot as repairs. But a full upgrade is an improvement. Capital works at 2.5% or just $1,375 a year per the ATO 2025 guide. That's an excess deduction of $53,600 in 1 year. Discovery 3 was the one she was proudest of, and it was worthless. Sarah flies from Melbourne to the coast twice a year to inspect the unit, $2,000 a trip, and claims $4,000 a year. But the ATO has banned residential rental travel for individuals since 2017. Over 7 years, she's claimed $28,000 that was always zero. Nearly $11,000 in back tax, waiting to land. Added up over a 4-year audit window, and Sarah is looking at $136,000 of excess deductions. At her 39% rate, that's around $53,000 in extra tax, before shortfall interest pushes the shock towards $60,000. That's several years of rental profit wiped out in one assessment. So could this be you? Maybe you claim 100% of your costs but use the place yourself or lend it to family. Maybe you've claimed a renovation as repairs in a single year, or maybe you've deducted flights or fuel to inspect a residential rental. If any of those sounds familiar, the next 3 moves are exactly what you need. These 3 moves aren't busy work. Each one removes a specific audit-triggering mistake from your return before the ATO's data matching finds it. Get them right, and you turn a $60,000 shock into a lower but completely defensible claim. Let's walk through each one with the exact tools and steps. Move 1. Audit your rental calendar and apportion correctly. Log into MyGov, then ATO Online, and open your rental schedule. Using your booking platform and agent statements, separate the weeks rented at market rates from the weeks you used it yourself. Then apply the apportionment rules in the ATO's 2025 Rental Properties Guide to recalculate the deductible share of every expense. Here's how, step by step. Open ATO Online, go to Tax, then Lodgements, then Income Tax. List every week the property was rented, available, and privately used. Then recalculate the deductible share for each expense type. You know it's right when the weeks in your return match your booking calendar exactly. Move 2. Separate repairs from capital works. Pull every job from the last 5 years and tag each one. Restoring original condition is a deductible repair. An upgrade that improves the property is capital works at 2.5% a year. And fixing a defect that existed when you bought is also capital, not an instant deduction. Step by step, gather every invoice for works over the last 5 years, tag each as a repair, an improvement, or an initial repair. Then move the improvements into capital works at 2.5% annually. You've done it right when no upgrade sits in your return as an immediate deduction. Move 3. Strip out the banned travel. Since the 1st of July 2017, individuals cannot claim any travel relating to a residential rental, flights, car hire, accommodation or meals. Go through your open returns and remove every inspection trip deduction before the ATO disallows it and charges you interest on top. Here's the process. Find every travel line across your last 4 returns. Confirm you're genuinely not in the business of letting property, because that's the only exclusion. Then lodge an amendment removing the travel claims. Success is simple. 0 travel deductions on any residential rental. Why act now? 3 dates tell the story. From the 1st of July 2017, residential rental travel deductions were abolished. In 2021, the ATO's random inquiry program found 9 in 10 returns needed adjustment. And in 2025, new guidance, draft ruling TR 2025-D1, plus the leisure facility rules, lets the ATO deny holding costs on holiday homes entirely. With data matching live, the 4-year window is no longer protecting you. After you act, check it actually worked. You should see your week's rented figure match your booking records. Confirm every renovation now shows as capital works at 2.5%, not an instant deduction. And if any travel claim is still sitting in an open year, lodge an amendment to remove it. Everything I've quoted today comes straight from the ATO's 2025 Rental Properties Guide, the ATO's Rental Expenses page, and tax specialist analysis of the holiday home crackdown. All the links are in the description so you can check the apportionment and capital works rules for yourself before you lodge. So today you learn the 3 rental deduction traps the ATO targets most: overclaiming for private use, mislabeling renovations, and banned travel, and exactly how to fix each one yourself. Next week, we're tackling whether negative gearing is actually working for you or quietly working against you. If this saved you from a $60,000 surprise, hit subscribe so the next one finds you. We read the fine print so the tax office doesn't catch you out, and there's a new investigation every week.